You're going to start seeing some big changes here at Wall Street Winners. That's right. For all the fully paid up members, we're going to be expanding our coverage into some special areas that you're going to love. They're going to change your life, and that's why we're going to add them to them. So this week will be the same Wall Street Winners that you love. But starting next week, we're going to start doing some very interesting in-depth analysis of some of the biggest issues facing this country, and they'll be part of our fully paid up members section. They're going to really, literally change your life. All right, let's get right into it. This will change your life as well, of course. Now, S&P 500, what can I say? Look at this. Now, watch these first three charts. S&P, not quite up to a new high. But the Dow did make a new high. You see that? Okay. And then, so S&P not quite a new high, Dow a new high, Nasdaq the weakest of the three. So you get the idea. The market wants those big cap, boring stocks right now. They don't want the frisky Nasdaq stocks, okay? So keep an eye out on that. We want boring stocks. That's how we're going to be making money. Now, seasonality remains bullish. I'm using 164 as my flip point. If we go below 164, then I'll throw in the towel on the bullish seasonality. But look at this chart. It starts in the lower left and ends at the upper right. That's a bull market. That's a bullish seasonality. So as a result, I've got double size positions on because we have a tailwind of seasonality pushing the market higher. According to Stock Traders Almanac, we're almost there at the explosion time. You can see basically the beginning of October, the market should start going straight up. Ned Davis, beginning of October, the market should chop higher. He doesn't have it quite as straight a line, but nonetheless shows a clear bull move to the end of the year. So I don't see any reason why this isn't going to happen. So let's just watch and let's sit back and hopefully we can make a bunch of money here in the fourth quarter. Now the yield curve, like I say, it's not going to be a big player right now. It's kind of a year, right now, which projects a year from now is the yellow line. And you can see it's pretty choppy, but sideways into June of next year. But you can see in the lower right-hand corner, that would be projecting into September of next year. We didn't quite get down to a super dangerous level, but we did get down to a yellow caution zone. We're backing up away from that, which is a good thing for the market. Asset allocation moved to a new all-time high, and that's fantastic for the market as well, because basically it's saying that we're sucking money out of... well, let me back up. Bull markets require liquidity. They require money to go higher. Where they got to get the money someplace. It's got to come from cash or bonds. That's the only two places there is. There's a microscopic amount in gold or Bitcoin or something like that, real estate. But the bulk of it, 90% of the money available for the stock market, has to come from bonds or cash. So seeing this tells us that cash is flowing out of bonds and providing the raw material for a bull market in stocks. The RISKDICATOR, though, now remember we talked about the Dow was the one that was leading to the upside. It's the one that has broken to new highs. Well, the RISKDICATOR is telling us that the market doesn't want lots of risk. They want those old, dull, boring Dow-type stocks. So you see how I hope you're seeing how this is all fitting together here. So global shares, I keep saying who cares? Because, I mean, really, who cares? Bonds, big disappointment to me. I thought the bonds would rally and go up to new highs. They have not, and I'll show you why. Here's why. The thing that's the most important factor is the competitor, which is the 10-year Treasury in Germany. That's the blue line. Last week, it had kind of stabilized, but this week it broke to new highs, and that pushed yields to new highs. The other two indicators, still suggesting lower interest rates, but the most important one is the blue line pushing up the green line. Now the dollar may be, it's a little early to tell, may be putting in a head and shoulders top. If we break below 90, let's call it 94.40, in other words, Friday's low, that to me would be an indication that we're going to see this market drop maybe 200 pips pretty quickly. Gold, if the dollar goes down 200 pips, then most likely gold will break to the upside, and we'll have our first, at least mini rally that we've had since in the first quarter of the year. So at this point, we're in the middle. Best thing to do is stand aside. It's not going anywhere right now. The indicators, the top indicator, neutral. The middle indicator, neutral. But the bottom indicator started to break down again after being neutral for the last little while. I've been telling you, who cares about oil? It's not going to go up a lot. It's not going to go down a lot. The supply and demand balance is very, very steady right now. So just look for it to stay in this big trading range. Finally, Bitcoin, look for it to continue to be weak. Coming up here, we'd already finished one of those, but coming up here in the next week, we're going to be in Las Vegas for the Stock Financial Freedom System. Coming up in early October, Option Success School. End of October, Futures and Forex Trading Masterclass in Dubai. And then in January, we don't have the exact date yet, we will be doing Extreme Profits in Dubai. We'll also probably, in a couple of weeks, we're going to probably add a bunch more events to our calendar. So all of you freebies, you want to find these great stocks, go to stockbutler.com. It's a peanut, and it'll show you exactly where we get the tremendous stocks where we've been crushing the market. Nobody even comes close to our track record. All right, thanks very much, freebies. Fully paid up members, hang on just a second.